Did you know that the average Australian homeowner could save over $4,000 per year by refinancing their mortgage? That's enough for a dream holiday, a new car, or a significant boost to your savings. But before you rush to hit that apply button, there's a lot you need to know. Welcome to Dollars and Dreams, the podcast designed to empower you to take control of your personal and business finance. You know, the very thought of money and finance can often send chills down your spine and stir up fear of the unknown. But let's change that narrative together. Through this podcast, my goal is to not only to provide you with useful information, but also to inspire and motivate you to take action towards your own financial goals. Let's rewrite your money story together. Well, hello and welcome to today's episode of Dollars and Dreams. In today's episode, I'm going to talk about something that we hear all the time: refinance your home loan. The reason that people will say that with a very blanket statement is because some people don't understand that there are some consequences to doing this. Now, don't get me wrong, not for a minute am I saying you shouldn't refinance your home loan if you can get a better rate somewhere else. But of course, with every action, there is a reaction. So refinancing your home loan can be a really great thing to do, provided you follow the steps that I'm going to go through in today's podcast. Of course, if you need to know anything more about refinancing, reach out to me at jenrichardson.co, because if you get refinancing wrong, it can be a really costly error for you and your family. And I'll go through what that means when we get down to the ugly bit. So today's episode is titled The Good, the Bad and the Ugly of Refinancing. Mortgage brokers, the money coaches and everything will only ever tell you about the good. And the good is good, don't get me wrong. Everybody should constantly be looking at refinancing or getting a better rate. But there are costs to that. And if you don't refinance correctly, you could end up being worse off. So the holy grail, of course, of refinancing is to make sure that you get a better interest rate. And of course, we've gone through the last couple of years where interest rates have risen. You know, we got quite comfortable in lower interest rates over the last few years. You will hear people tell you all the time, which annoys the hell out of me, is, oh, the kids today are lucky because back in my day, interest rates were 18, 19%. Now they're whinging that they're 5 and 6%. The reason that interest rates were that high was the price of housing was considerably lower than it is now. Don't for 1 minute think that just because you're on a lower interest rate that you will pay less interest than somebody that was paying in the 80s was paying. That is where refinancing comes undone. Everybody thinks that by refinancing their home loan to a lower interest rate, they will pay less in interest. When we get to the ugly of this podcast, I'll show you exactly why that's not the case. So let's go back to the good of refinancing. Cost of living is higher now than it has been. Inflation's higher now than it has been for a lot of years. And of course, interest rates are higher now than they have been for the last few years. So refinancing your home loan will always make sense if you get a lower interest rate and follow some other steps. So the holy grail of refinancing, of course, is a couple of things. It's not always about interest rate, although that primarily can be one of them. It may be that you want to do a renovation, and so the lender that you're with may not allow you to borrow as much. Every lender has a different amount that they will lend you. Your borrowing capacity with that lender is what's important. That is the skill of a mortgage broker. So if you want to do your own refinancing, you'll go to your local banks, you'll ask them what they can do, or you'll jump online and do it. That may not always be the case. So if you're wanting to do a renovation on your home, some lenders won't lend you money if you're going to go outside the footprint of your house, meaning do an extension. Some lenders will lend you more than other lenders. So if you're looking at refinancing, I strongly suggest that you talk to a mortgage broker because they can walk you through the steps of what needs to be done so that you're still better off financially. Keep in mind, I said in my podcast a couple of weeks ago about what the advantages of a mortgage broker is, and a mortgage broker is bound by the know your client. And if they don't do that, then you can report them. A lender does not have to do that. So a lender just has to offer you an interest rate. A mortgage broker has to comply with the know your client regulations, which is what we call BID, so best interest duty. They have to abide by that. So if you go to a mortgage broker, they will be able to work out what your wants and needs are from your loan, and they can then do it. So refinancing your home loan, let's just say for the moment, all you're doing is refinancing the loan. You don't need any money. You don't need a cash out. You don't want any additional services or anything. You just want to refinance your home loan. The sweet low interest rate obviously will mean that you can save thousands and thousands of dollars over your life of your loan. A small reduction, you might look at that and go, oh, that's a lot of paperwork for 0.5%. That 0.5% could significantly give you a couple of $1,000s a year, depending on the balance of your loan. So if you can do a couple of hours work to save yourself a couple of thousands a year, that's not a bad hourly rate. Think about if your employer asked you to come in and work and he was going to pay you $1,000 to come in and do an hour's worth of work, you'd be running out the door, grabbing your work bag and knocking people over to get to work. So if you can save yourself $1,000 by doing an hour's work to refinance your mortgage, then you should be doing that as well. You should be running out the door to try and refinance. If you're using a mortgage broker, the amount of work you need to do would be significantly less. The other good thing about refinancing your home loan is what we call debt consolidation. So debt consolidation is bringing all of your loans into one loan at a lower interest rate. So if you've got credit card debt, you've got a personal loan, you've got a car loan, you've got buy now, pay later loans, and you've got a home loan. We can pull all of that into one, and then you get a lower interest rate. But there's a huge catch on that one, and I'll go through that when we get to the ugly. But bringing everything into debt consolidation means that you've got one debt. Psychologically, and I'm all about mindset when it comes to our money, that the way we think is the way we act. If you've got one loan, you might have a bigger figure, but when you psychologically look at 6 loans, it can be quite daunting. Yes, the dollar figure of consolidating into one loan is the same dollar figure. I'll give you some strategies when we get to the end of how you can make sure that you benefit from that, because as I said in the ugly, I'm going to show you the problems with that debt consolidation. You can then work at just paying off one debt. You can really just see the impact of extra payments and everything because you're looking at one. Instead of looking at the huge number of loans you have, you can look at one and take a really positive approach that you're going to get rid of that. Debt consolidation can also reduce your monthly payments because you're moving it out of a higher interest rate into a home loan. Now, that's part of what we'll talk about in the ugly, but if you're struggling and you're using credit card debt because you're struggling to survive, you're trying to put things in place, it can free up your cash flow. But I really want you to think about it as a short-term issue because you can then fall into a longer term of paying that higher interest rate, which means it might be more than if you'd stuck with the lower one. And that's where I introduce this by saying that at the very start, when people compare the 17, 18, 19% that were around in the 80s to now, and they say that people borrowing now are lucky, it isn't the case because they were paying far less interest because they borrowed far less. So back in the 80s, I always say most people could buy a house for 3 times their annual wage. You have not got a chance in Razoo. I was going to say something I shouldn't have said then. But you've got no chance of buying a house now for 3 times your wage. So you will pay more interest, even though they're lower interest rate than those of the 80s. And that's what I will talk about when I get to the ugly of refinancing, because you could end up paying way more interest, even though your interest rate is lower because you've refinanced it into your home loan. Of course, if you've been living on credit and buy now, pay later, refinancing into a debt consolidation position does not change the habits and behaviour you have. If you are going to do debt consolidation to save interest, you need to change your spending behaviour or habits. Otherwise, you're going to end up in the same position, but worse off, because now you have this home loan that's bigger than it ever was because you've done debt consolidation. And then we've got the credit card debt again, and then we've got the buy now, pay later and the personal loan. All of a sudden, you are in a far worse position. Debt consolidation is about drawing a line in the sand and saying no more from this date onwards. So you need to get an emergency fund set up. You need to do a budget to work out what you can spend after you've paid your mortgage and after you've put money into your emergency plan and after you've put money aside for the long-term and short-term goals. So debt consolidation is a tool. Remember, money is only a tool. It's not anything that does anything, but it is a tool to make your life better. It is a tool for you to get ahead financially, and it is a tool that is up to you to control. So if you've done debt consolidation because you were not in control of your money and you got into a position that you couldn't afford to be in, you need to draw a line in the sand to say, from today, I don't have any credit card debt. I don't have any buy now, pay laters, which is debt. I don't take out any personal loans, and I just live within what I can afford to live. So the lower payments that come about with debt consolidation is a tool for you to get your emergency fund in place so that you don't turn to short-term debt when things happen, because things will always happen in our financial life. So fridge is always going to break down at some point. The car will need new tires at some point that you didn't anticipate because, something happened. Kids might need some medical treatment that you hadn't budgeted for. That is what your emergency fund is for. I want you to prioritize your emergency fund if you have done debt consolidation, because your emergency fund is there to stop you recreating debt that you just got yourself out of. So 2 purposes. The good of refinancing is it will reduce your monthly repayment rate. If you're only doing a switch, so home loan to home loan, no cash out, no debt consolidation, no anything, it will reduce your monthly repayment, which will free up some money for you for your cost of living. So it's a good opportunity to find a way to not rack up debt. So if you find you're struggling to pay your bills or live, debt refinancing can be a way to free up more cash flow because you've gone to a lower interest rate. If you have done debt consolidation, you have found yourself some breathing space. Some breathing space to build your emergency fund, a breathing space to get a budget in place and get your 6 bank accounts. And I've done a podcast earlier on the 6 bank accounts. So if you don't know what I'm talking about, go listen to that podcast. And then, of course, it's about paying off your debt nice and quickly. So let's move in to the bad. Now, the bad isn't such a bad thing. There's always good and there's always bad. You know what I always say about wherever there is action, there is a consequence. If you have a consequence, some of those consequences are good and some are bad. Consequences are always thought of as in a bad perspective, and it's not. You can have a consequence that means you're going to pay your debts off quicker. That's a great consequence. The consequence here that I'm talking about is there is costs to refinancing. So if you walk into a bank and you tell them you want to refinance away from Bank A to your bank, which is Bank B, they will not tell you that there is a cost to refinancing because they don't have to. Remember, a mortgage broker does have to tell you those costs and has to weigh that cost up. So there is always a cost to enter a new loan, and there is always a cost to exit a loan. So there's application fees, there might be valuation fees on your property, there could be settlement fees on solicitors to make sure that what you're doing is correct. There's always going to be settlement fees paid to the lender for taking out a new loan and the old lender for wiping your loan. So keep in mind that each lender will have a different exit or entry fees. So it is important that you look at those. Quite often we will look at a client that will come to us and they might have under $100,000 owing on their home loan, but they've got there because they've been really savvy with their money. So they go, well, I'm on a really high interest rate compared to this bank. Why should I not refinance? But when we look at what they're paying it off, and let's say they can pay off that $90,000 loan in the next 2 years, and we look at the savings of interest on that $90,000, then we take into account their exit fees and their entry fees. And we will quite often say to them, if they're in that case, it's actually going to cost you more to have that lower interest rate than it is to stay where you are because of the entry and exit fees. A mortgage broker will look at all of those for you, but it's something that you need to be conscious of. So when you hear this touted through social media, even in the general media, I was watching one of the morning breakfasts last week and they went refinance, refinance, refinance to get ahead. And I thought, except if you have a strategy to pay it off quickly, except if your home loan is quite low in the balance, because you don't get great interest rates when they're low, because the new lender says, well, I'm actually not going to get much interest out of you at that balance, so I need to do this. Except if you extend your loan term, except if your circumstances have changed and your borrowing capacity has reduced. So you might have been, a couple, no children, and now you're a 1.5 wage family and 3 kids. Your borrowing capacity may have changed. So there's this other thing that we call repricing. So in those circumstances, you might be better to go back to your lender to reprice. So it frustrates me as a mortgage broker, and I'm a financial advisor as well as an accountant. It frustrates me that we hear these throwaway lines from people who are not trained in the areas that I'm trained in. And you'll hear it. My neighbour said, I've got to refinance my home loan. Yeah, okay. But what about this? Oh, they didn't mention that. What about this? Let's look at each person's individual circumstances. I'm not for a minute saying you shouldn't refinance, but you need to be very aware that there are costs to refinancing, both in the upfront costs and the extended loan terms. So what do I mean by extended loan terms? Well, if you've got a mortgage that you've got 18 years left to pay on it, you go into the bank and you say to them, look, I'm really struggling with my cost of living. Everything's going up. Is there any chance that you can refinance my home loan across from Bank A to you? Of course, they're going to say, absolutely, we can. And you know what? We'll actually get your monthly rate down from, and I'm just going to throw figures here, from $1,200 a month to only $1,000 a month. And you go, great, an extra $200 a month? I could use that. So you sign up. What they've done is not necessarily changed your interest rate. It might have come down, a 0.2. They threw the monthly payment at you because you told them what your pain point was. And your pain point was your monthly payment. What they don't then explain is that they've taken your home loan from an 18-year home loan to a 25-year home loan, for example. That means you're going to pay interest for another 7 years than you would have when you were with Bank A. That means that saving is not actually a saving because you've extended your loan term. And I'll go through that. As I said, this is the part of the ugly, which I'll do in just a minute. So when you change with a lender directly, not go through a mortgage broker, that isn't explained to you. They don't give you this is what your total interest you're going to pay now is, this is what the total interest on your new product is going to be. If they did give you that, it would show that you would be worse off in the cases I just talked about. So they don't show you that because your pain point was your monthly payment. Now, don't get me wrong. I understand that everybody is struggling with the cost of living. Everybody is struggling with their monthly payments because we got used to our low interest rates. We got used to having a disposable income after we'd paid our mortgage. That has changed. I understand that. Where we're seeing the interest rates sit at the moment, it's probably going to sit here for quite some time. So changing your mortgage payment can be a short-term goal. Don't get me wrong. If you're struggling with bills, you don't have your emergency fund set up, you don't have a budget in place, and you're not using your 6 bank accounts, then you are going to struggle. And what that Bank B has offered you, the extra $200 a month, can be a saviour for you. But remember, if you don't put something in place to change it, you're going to be in the exact same circumstances. Getting an extra $200 a month is great as long as you do something constructive with it. And I can hear you all saying, but I need that $200. My groceries have gone up. We've done this, we've done that. That's what a budget is there for, to work out a way to put savings in place with your spending. The other thing that you need to be very careful of, and it's the one that again frustrates me when I hear these money mentors or money coaches talking about it, is that you can lose some benefits when you refinance because you might be on a loan product that has an offset. Any or most loans that have an offset account will have a higher interest rate because you're getting an advantage through using that offset to save on interest. And so the bank go, well, we're actually going to lose interest because you're going to put money in your offset account. So we want to counteract that with a slightly higher interest rate. If you are moving from a bank account or a loan that has an offset and you move it into an account that only has a redraw, potentially offsets and redraws are much the same. They are very much the same. They work in the same way. They reduce your interest that you pay out of each of those mortgage payments. But the advantage of an offset is it is sitting there in isolation. So we have people that will put money into an offset and they know that that's for their long-term savings. So if you haven't done my 6 bank accounts podcast, go have a listen to that one because I talk about if you have savings and you have a mortgage and you want to save for, I don't know, a holiday overseas. You want to take the kids away overseas, you know you're going to $15,000. You will set money aside as your either short-term or your long-term savings to save for that $15,000. I always encourage everybody to always pay more than the minimum payment, but not much more. So I always encourage people when they're looking at their financial wealth to not so much pay anything more than the minimum payment because your interest rate is still a really good interest rate. The exception to that is if you've done debt consolidation, and I'll talk about that in a minute. But if you have a minimum payment going into your mortgage and you have offset accounts for your holiday, for your investing, for wherever you want that to be, you can see clearly that that money is set up for that. If it's in your redraw, you actually don't know how much of that money in your redraw is for your holiday, how much of it is for the new car that you're going to need, or how much of it is there for anything. You have it all blended into one. Now, as humans, we learn better from sight than we do from reading. You will see X amount and all of a sudden your holiday's gone from $15,000 to $20,000 because you see that there's $20,000 sitting in your redraw. You will forget that $5,000 was there for a new lounge that you wanted or a new car that you wanted, or you want to upgrade your house. So you're saving to do a new house. The other thing with an offset account is that if you're looking at your home as not being your forever home, you want to save for a new home, but you want to turn your existing one into a rental property because that might be part of how you're going to build your future wealth. If you pull the money out of your redraw to buy your new home, that part of that loan is then not tax deductible to your investment property. If it is sitting in a redraw, then you can take it and go and do whatever you want. One of the other things that I see about having a home loan, we've been sold a dream in Australia that you need to pay your home loan off as quick as you can. That is just not the case. If you're paying interest on a home loan at 5 or 6% and you can get an investment at 8 or 9%, just on the raw numbers, you're probably better off to invest in something. The other thing that the investing does is it allows you freedom of income, because if you lose your job, got dividends. You can't go shopping with one bedroom of your house. Yes, you've got your redraw to pull out and put back in, but if you're paying interest at only 5% and earning interest at 8 or 9%, probably you're better off to invest rather than pay your home loan. That's not the story of today's podcast, but that can be when you refinance. Sometimes you can lose your redraw because your borrowing capacity might have come down. So that can be something you need to look at as well as part of the bad of refinancing. So be very careful before you hit the button to move into refinancing. And I strongly recommend that if you're going to refinance, that you should talk to a mortgage broker, not just straight to a lender. It is too easy to get it wrong. A good mortgage broker will be able to go through all of those things. The other thing is, if you're doing your own refinancing, remember every time you put an application in for a home loan or a loan, investment loan, there is a hit on your credit score. Now, we were talking to somebody the other day that the banks have had these things going around for a little while called cashbacks. So if you refinance your home, they'll give you a cashback of $2,000, $4,000, and the amounts varied. We had a client that came to see us to refinance, and when we looked at their credit history, that's what they were doing. And in their mind, they were making money out of the banks. And that's a short-term view. Yes, you probably were. If you go to one lender, stay there for 6 months, because I think most of them, you have to keep your loan for either 6 months or 12 months. They were getting $2,000 or $4,000. They would then go, right, well, even if I'm paying a slightly higher interest rate, I've got my $4,000, it counteracts it. They'd go to the next lender, go for the cash outs, and they'd refinance, they'd get their $4,000, they'd keep going. The problem it got to when they got to us as mortgage brokers, they had such a bad credit score that the next lender didn't want to give them a good interest rate, because they knew that they were going to leave them as soon as their 12 months was up and go somewhere else. A lot of the cashbacks are now going, which is great, because they weren't good for people in the long run. So, of course, when you've looked at the good, the bad is the impact that you've extended your loan term. You may end up paying more interest. Then we get to the ugly. So let's talk about the ugly of refinancing. And this is the stories that you will never hear about through social media, through the media, or through people that want you to refinance, such as lenders or mortgage brokers. Now, mortgage brokers will always make sure that what they are giving you is the right product for you, but this is a really complex thing that we want to talk about here. So let's say you've taken your credit card debt. You were paying an interest rate of 19%. You've taken your personal loan, which had an interest rate of 13%. Or you had a car loan that might have had an interest rate of 9%. You then look at your mortgage and you go, well, I can refinance, and my mortgage interest rate is only 6%. So you move all of those other debts in. You're getting an interest rate of 6%. You then have extended your loan term because your home loan was at 15 years. The lenders say to you, that's great, we can extend your loan term out to 30 years. You've still got 30 years of working life left. That way it will be paid off, your debt's paid off, and your monthly payment has decreased by this significant amount. The problem is that you took a personal loan that might have had a 5-year loan term. Yes, the interest rate was higher than it is now because it's now in your mortgage. But instead of that loan being paid off in 5 years, you're now paying interest on that loan for 30 years. So the interest rate is significant when it looks at that. So, you take a credit card debt. You could have maybe paid it off in 12 months' time if you put some savings in place to reduce your spending. So instead of paying 19% interest for 1 year, you're now paying 6% on that balance for 30 years. Now, if you're not quite sure how banks calculate your interest, it's calculated on the loan balance, generally on a day-to-day basis. So if you're paying interest on that, let's say $5,000 credit card debt, you're now paying interest on $5,000 at 6% for 30 years instead of $5,000 at 19% for 1 year. The interest that you will pay when you look at it over the term is ridiculously higher in that 6% loan than the 19% for 1 year. So the interest rate is misleading. What you need to do is, if you do the debt consolidation, is you need to keep what was in place to pay that credit card off in 12 months and pay that as extra. So what we do when we refinance clients here is we say, this is what the repayment would have been on your home loan. This is what your repayment was on your credit card. This is what your repayment was on your personal loan. And this is what the repayment was on your car loan. Take the reduction you have on your house loan. So let's say we've taken the home loan from 15 years to the 30 years. So we've doubled how long we're going to pay that loan off. Keep that one, but pay your others as though it's still a 5-year loan, still a 1-year loan, and still whatever the loan term is of all your loans. If you can do that, yes, you will be in a far better financial position. But if you just take the monthly payment on your home loan, you will end up costing yourself money. So that is the ugly of refinancing your home loans and other loans. Even with your mortgage, so you've taken your home loan now from a 15-year back up to a 30-year. Two schools of thought there. If you want to get ahead financially and you want to do the great Australian pay off your home loan as quickly as you can, still keep the loan at a 15-year rate. That way you cannot change. So you can say to your lender, I don't want a 30-year loan. I only want a 15-year loan. Sometimes the lenders are extending it out to 30 years because it's the only way that you service by bringing the other debts in. If that is the case, you need to accept the 30-year loan, but then you need to take responsibility and pay it off in 15 years. So if that's your goal, because you may say, well, I want to retire early. I don't want to work till I'm 67 like the bank has worked out. I want to retire at 55. So you may need to look at that you pay your home loan off in 15 years. Now, if you're with a mortgage broker, they'll tell you the exact amount that you need to do it in the 15 years. If not, jump onto our website at jenrichardson.co. In our resources section, we have a ton of financial calculators in there. So you can do some calculations yourself to work out where you should be. The other misleading things that we see around the ugly of home loans is that you'll hear a honeymoon rate. Now, the honeymoon rate is where the lender will say, we're going to give you a 4% home loan for 12 months, and then it'll revert to our standard variable rate. They will calculate your home loan repayments on the 4% because that's what it is. In 2 years' time or a year's time or whenever that honeymoon rate runs out, you will switch to their normal variable rate, which may be 7%. They don't tell you that in a year's time or 2 years' time, whenever the honeymoon rate runs out, that all of a sudden you're paying a 7% interest rate, unless you ask the question. If you go to a mortgage broker, they will tell you, but they will also look at, you know what, sometimes we're better off to take the low interest rate while you build your emergency fund, while you build your budget, while you build your 6 bank accounts that you need, and then we'll refinance you again because you will be better off. So the lenders rely on us being lazy because, let's face it, 99% of us are lazy. And so they know that when that honeymoon rate runs out, you're probably not going to refinance. You're probably just going to roll into it. You might have great intentions of doing it. When the 2 years or the 1 year comes around, you might start the process and then you get busy at home. You know, going on holidays, I'll do it when I get back. And then, of course, time just goes on. You may leave that with your lender for an extra year, an extra 2 years. You may not even look at it because life just happens. That is a part of the ugly of refinancing. If you're with a mortgage broker, of course, they will put it in their calendar to ring you a couple of months out from that honeymoon rate finishing and then just say, look, let's go and re-sign you with somebody else. We'll get all the paperwork done. So again, that's another advantage of using a mortgage broker. So the temptation that we see all the time is people consolidate their debts into their home loan because, as I said at the start of this podcast, everybody feels overwhelmed when they've got 6 or 7 debts. They don't know how to get ahead. You know, we can all read online how we do the snowball or the avalanche method of paying off loans, but it is still very draining on your mental capacity. If you've got 6 loans, you're looking at constantly juggling money. Debt consolidation, if you can do it, is a great way to do something so that you get in the right mental headspace to actually pay your debt off and get ahead financially. So if you do have a home loan, please consider refinancing. It has got its good points as long as you are counteracting those negatives that I went through in the bad and the ugly. The good will always be the good, provided you counteract what you're doing so that the bad and the ugly don't happen. So keep in mind, refinancing, there's a cost in and out, which is the part of the bad that I talked about. There is a risk of extending your loan term, so therefore paying more interest, even though your interest rate is better. And there is the risk that you will pay more in interest because you extended what was a high interest rate to a lower interest rate, but then paid interest on that money for longer. So that's it for today's podcast. I hope that has helped you. And I think it should be a warning to all of us not to take what's on social media or the media or anywhere without digging in to the pros and cons. There is always pros and always cons to every action that you do. The skill that you should have as a really good financial person is that you know what those cons are so you can counteract them so that you still end up in a better financial position. So that's it for my podcast today. As I said, there's heaps of resources over on our website, jenrichardson.co. If you jump in the resources tab, there's calculators, there's a heap of blogs about what I've been talking about. There's free webinars in there. And of course, there is my signature program called My Money Makeover, which I cover off on all of this so that you can get a better financial position for yourself. And of course, for any of the Australian listeners, I also have the financial blueprint, which is going through all the things that we talked about today. So loans, it also goes through your superannuation, investing, insurance, estate planning. That is only for Australian listeners. If you know somebody that could benefit from listening to my podcast or watching my podcast wherever you're doing that, please let them know or send them over to my website, jenrichardson.co, where they can also get the benefit of all the resources that I have there. If you need more help with your financial future and getting out of the rut that you're in, come join me over in My Money Makeover. So that's it. Don't forget to like and subscribe so that you will get my next podcast when it drops. And if you've got any questions, you can reach out to me wherever you're watching or listening to this podcast, or you can email us at hello@jenrichardson.co. So have a lovely week, and I'll see you next Thursday if you're here for the personal finance, or next Tuesday if you want to know more about how you can be better with your business. Have a great week. Remember, the advice shared in Dollars and Dreams is general in nature and it does not consider your own personal circumstances. Dollars and Dreams is for educational purposes only and should not be relied upon to make investment or financial decisions. If you need more help, please reach out to a financial advisor for tailored personal advice. Don't forget to click that subscribe button so you don't miss out on future content. And please leave me a review. Your feedback really helps me to reach other people chasing their money dreams. You can find me over on Facebook and Instagram to connect with me. You will find the link in the bio or head over to my website at jenrichardson.co where you will find free content and learning tools.